I'm Cardiff Garcia of FT Alphaville. I'm joined today by James Sweeney, Chief Economist of the Credit Suisse Investment Bank. Our topic today is the outlook for the U.S. economy. James, let's start with labor market slack. It's what everybody's talking about now. 6 straight months of 200,000 plus payrolls. What's your take on this?
Well, I think the labor market has definitely found a higher gear. How long that we stay in that higher gear is an open question, but no clear signs of it falling off track recently. That higher gear means that slack is diminishing at a faster pace. How much slack there is, people can pretend they know the answer. No one knows the answer. NAIRU, I think, is a little bit of an imaginary number. Probably no wage pressure on the immediate horizon, but faster diminishing slack, mid-5s in the unemployment rate, not out of the question by the middle of next year. Inflation's running at 2%. You know what that means for monetary policy in an economy where the Fed funds rate is 400 or 500 basis points below nominal GDP growth, and credit market conditions are getting very easy.
Okay, let's talk about two parts of the economy that I think a lot of people going into the year expected to really rebound a little more strongly: housing and CapEx. What's your outlook on those two things?
Well, on housing, I'm actually, weirdly, a little bit encouraged that this pickup that we've had is not housing-centric. I think it's good that the unemployment rate is charging lower without being strongly dependent on a big pickup in the number of construction workers hired.
Do you still think there's going to be a more powerful rebound in household formation?
I think eventually, but I mean, I've been a little bit premature in calling for that recovery, and we haven't seen anything recent to suggest that that's picking up sharply. You could guess that because of the labor market doing a little better, household formation should pick up a little more. But in short, we don't see evidence that suggests that you're going to have a sudden boom in either formation or really in any of the activity indicators in housing anytime soon. But with the labor market tightening up, that actually tells me we've got a pretty sustainable pattern of recovery.
Okay, how about business investment?
Business investment also, I think some people go a little bit overboard with how much business investment could pick up in the near term. We see underlying real growth in equipment investment at around 6% real terms per quarter for the coming quarters, which is pretty good, but in previous post-recession bounces, it could go substantially higher. Thing is, we're pretty far from a recession at this point.
Sure.
And a lot of investment in the most capital-intensive parts of the economy, things like mining, actually happened several years ago. So there's upside, should be better than normal, but we don't expect an explosion in business investment soon.
Okay, so obviously everybody looks at these trends and they're trying to pinpoint the date at which the Fed will finally raise rates. Rather than trying to do that, why don't you just talk about how we should think about the reaction of asset markets to that eventual starting point, when financial conditions actually start to tighten a little bit?
Well, can I twist around what you said a little bit?
Of course.
I want to actually think about the Fed in relation to asset prices. I think it's customary to think of the yield curve as telling us something about the likely path of the Fed. But sometimes markets can actually diverge a bit from the growth data and start to drive what happens in growth and what the Fed might need to do later. I think what's happened of late is that interest rates have not been very responsive. Market interest rates have not been very responsive to the pickup in economic activity and especially the labor market that we've seen. And that suggests that financial conditions have gotten very easily recently, and that's actually driven by the markets, not by the Fed. Okay. So when we go out several quarters, it could be that if we continue to have these kind of easy financial conditions where yields aren't picking up even though growth is humming along, that's the sort of thing that could move the Fed into earlier hikes. Or in contrast, maybe what will happen is a little bit more strong growth data will trigger a sharp move in yields, and that incremental tightening of financial conditions delays when the Fed actually goes. And if I had to guess, that would be the scenario I would expect to see: higher interest rates and a small delay in the Fed pushing that first hike back into the middle of next year rather than earlier, like some people are starting to think based on the most recent data.
Right. Okay, final question. Let's talk about the global economy. Your office looks at something called global risk appetite. Talk about what that is, what it's showing now, and talk about the potential impact of geopolitics. It's been so much in the news recently. How should we think about all this?
Well, global risk appetite is a measure we've been publishing for 14, 15 years. which effectively tracks whether investors are buying risky assets, high volatility assets like equities, instead of low volatility assets like bonds. It moves with the growth cycle, it's influenced by policy, and sometimes it has a life of its own as markets do. Recently, global risk appetite has been moving up in the last few months as global growth has begun to accelerate in the last few months, manufacturing activity, that is.
Is it at worryingly high levels, or is it appropriate?
It's not at worrying high levels, but there is something puzzling with it. We look at different risk appetite indices with different sets of indicators, and we have one that just looks at the bond market. We call that duration risk appetite. Usually duration risk appetite moves inversely to global risk appetite, and right now it's signaling really extreme demand for duration, something normally associated with a period of very weak growth and tumbling risky assets. So right now, investors seem to not be shunning risk. They like equities, they like corporate bonds, a little bit of turbulence in the last few weeks, but nothing too severe. But they like duration even more, and that's what's unusual, and that's what I think could reverse itself in the months ahead.
Okay, and all the geopolitical news we've been getting lately, something to worry about?
I think it's definitely something to worry about. I think all of these, what's happening in Iraq, what's happening in Israel, Palestine, and what's happening in Ukraine and Russia are all things to be concerned about as a citizen of the world. In terms of their impacts on economic activity, I'm not sure any of them clearly give a major economic shock. Sure, Russian imports from the EU are bound to go down. The oil market seems disrupted by what's happening in Iraq, although with the U.S. now more
picking
involved
up some
there,
of the slack, right?
Maybe that means oil is actually a little more secure than it was before. Israel, Palestine, hard to map to any specific economic shock. So I think these things weigh on sentiment, particularly the Russian shock, but none of them at this point are sufficient to really downgrade a global economic forecast.
All right. James Sweeney, thanks for joining us.
All right, thank you.
And to see more, go to ft.com or ftalphaville.ft.com and click the links below. Thanks very much.